Great. We are going to look at for consolidation into a bit detail. So, consolidation of financial statements. Basically, it's an exception or example of substance over form. So let's see how consolidation form of substance over form, basically. So, and then we'll look at for all the standards that govern the consolidation. Let's see. So we will call it consolidated financial statements. So call it consolidated financial statements. Good. So that is it. That is the section that we are going to look at for the section. Now, when you talk about consolidation, simple means we are just going to combine or add financial statements together. Good. Now, we are going to list few of the IFRS that govern the consolidation. But you see about 5 standards and then 1 company's code that govern the consolidation. Let's see consolidation, the standard that govern consolidation. We have the first standard, it's IAS 27. IAS 27 talks about separate financial statement. Separate financial statement. That is the financial statement. That's IAS 27, number 1. The next standard that governs consolidation is IAS 28. Investment in associates. So investment and the consolidation of IFRS, but apart from IFRS 3, business combination. IFRS 3, business what? Combination. Business combination. Number 4, we talk about IFRS Almighty 10. IFRS 10 talks about consolidated financial statement. That's the console itself. Consolidated financial statement. So consolidated FS. Great. We go to standard number 5, IFRS 11. We call it joint arrangement. IFRS 11, joint arrangement. And then finally, number 6, we use the company's code. So the country that you find yourself can also get some few regulations and few requirements given to us by the company's code. So in Ghana, for instance, get from the company's code 2019 at 992. So these are the specific IFRSs that govern the consolidation and then the company's code. So let's examine now the company's code, and then you tell us company's code 2019 at what 992. That is it. That's 992. Okay, then let's start with the actual consolidation. You see, consolidation have a lot of issues. Each and every standard have its role. For instance, I-27 is saying that, okay, you guys should pay your financial statement separately, fine. Then I-33 is saying that, well, if you have an investment, which is in the form of associates, I-28 give you the accounting treatment. Then IFRS 3 said, okay, don't worry, anytime you combine your business, don't forget me, business combination, into a more business that was joining together, acquisitions and mergers. IFRS 10 is consolidation, combining their financial transactions together. IFRS 11, joint arrangements, like joint venture, joint operations, and then many more. Okay, so let's quickly go through the fact that consolidation is an example of what? Substance over form. So why is it consolidation a substance over form? Let's see the substance, let's see the form. When we talk about consolidation or substance over form, with substance over form, we are saying that there's transaction where the legal form is materially different from what? The economic reality. So put legal form here, know that every transaction has two sides, apart from the debit and credit. You have the legal form, and then you have the substance or economic reality. Let's take an example, consolidation. Legally, is there any consolidation or group? Let me even call it group. Legally, there was no group. Yes, there's no group. Legally, no group. Why? Because each and every subsidiary or the company registered business solely, individually. Yes, because imagine a company where the parent is in South Africa and the subsidiary is in, let's say, Ghana. The parent will be registered under South African Companies Act, while the subsidiary is under Ghana Companies Act. Fine. So what happened is this. Legally, there's no certificate given to the group of companies. No, individually, you obtain a certificate. So no group exists. But because we are one, in reality, because we are related and we are treated as a single economic entity, and it makes us what? One. So in reality, we do have a group. Yes. That's what? A group. I saw. Now let's start with actual discussion. So I'll define some few terms for us to get it. Then we move on. So first, let's look at some terms. First of all, we'll start with parents. We'll start with parents. So there are some terms that we are going to mention frequently, and we should know. I'll start with the, let's say, parents. And let's start with the consolidation first. Consolidated financial statements. So consolidated financial statements. What's the meaning of consolidated? The word consolidated simply means we are combining financial statements of a group of companies together. That is all. So if company A, company B, company C, company D, all of them are in the same group, all of them prepare their individual financial statement 30, maybe 40, these are their profit 20, these are profit 10. We put it together and we have what group account, and then we are done. So when we mention consolidated financial statement, tell the examiner, are the financial statement of a group presented as if it's a single economic entity. So consolidated financial statement is a financial statement prepared for a group presented as if they are what? A single economic entity. And line word is what? Single economic entity. Single economic what? Entity. So consolidated financial statement simply means we are paying financial statement for a group of companies as if they are all one. So now we will look at for the group. Let's look out for group and parent. So that's the next section. I'll look out for group and then parent. So let's see group. When you mention group, group simple means it is coming together of parents and what? And its subsidiary. So group consists of parent and what? Subsidiary, made up of parent and what? Subsidiary. So parent and sub. The subs can be many. Good. That is all. So group is made up of parent and what? Subsidiary. So who is a parent? Who is a subsidiary? So C and D, I will now talk about parents, talk about subsidiary. Subsidiary. Now, parent simple means a company or entity that controls another entity. That is all. So if you control parent, it's just an entity, a corporate entity that controls another entity. That is all. So if A controls B, A becomes what? Parent. B becomes subsidiary. And that one, parent and subsidiary. Subsidiary is an entity that is controlled by another entity. I'm just revising the definition. That is all. Now let's go to control. Very important. Now we mentioned that if parents control if let's say A controls B, then we say A is a parent, B is a subsidiary. So this control that we are talking about, what control? And how do we define control? So let's go. Another term, control. Now, control, we are saying that it is the power to govern the financial and operating policies of an entity to obtain what? Benefits from its activity. When you mention control, it's just the what? Power to govern the financial and operating what? Policy. Good. So control simply means the power to govern the financial and operating policies of an entity to obtain what? Benefit from its activities. Those one glasses. Control. So in short, control simply means you do have the power to govern the financial and operating activities or policies, meaning that you can make policies, you can remove a director, you can appoint a director, You can make financial, you can let them acquire certain assets for your benefits. That is the control. How you get it? You do this by voting. That is all. You don't do this, go and make like you don't do this through managerial influence. No. It's by voting. So if they are buying assets and then you don't support it, when you vote, since you have control, your vote like rule the entire organization. That is all. So if you say yes, let all those who say no come. But your yes will supersede all those who say no because you have control. Basically. Okay, then if there's control, then we also have what we call non-controlling interest. I'll talk about control and how we measure control. Very important. How control should be measured. Good. How control should be measured. How control should be measured. An issue of control. So I'll look at them carefully. But now I'm just defining terms. Good. So let's look at non-controlling interest. Non-controlling interest. Now, there are some people, they don't have control, but they have interest. Control simply means you have the power to make a decision in someone's life, to make an impact. Now, non-controlling interest, they do have interest, but they don't control. Good. So that is that. So non-controlling interest. Formally, we call them minority interest. And they say we're insulting them. And now we call them non-controlling interest, not minority. They are minor. So that is it. This refers to the portion of the profit and loss or the net asset of the subsidiary attributable to the equity interest that are not owned. For instance, let's assume that you owe 70% of an entity. So you are controlling 70% of the entity's net asset. The other people, all the other people, combining them together, they owe 30%. So you call them what? NCI, non-controlling interest. They do have interest, but it does not amount to control. That is all. Okay, I'll move over the net assets or portion of. Good. Non-controlling interest is the portion of the profit and loss or the net asset of a subsidiary. So just a portion of the profit or loss or the net asset of a subsidiary attributable to equity interest that are not owned directly, indirectly by the parents. That is all. So part of the equity shares that are not owned by who? The parent. So if the parents have, let's say, 70% control in, let's say, the subsidiary, so the part which are not owned by the parent, so parent owes 70, that means other people who owe what? 30. This 30 becomes what? NCI, basically. So that is the NCI. Now let's go to associate. Before I start with the associate, I want to draw something, or I want to walk you through what you call the accounting boundary. If you understand this one, you understand it very well. Now, if someone has called this one accounting boundaries, from 0 up to 19, if up to 19%, what do you have? So 0% up to 19%, 20% up to 49%. If you have exactly 50%, if you have 51, up to 100%. Have you seen these three or this item? These are important sections in consolidation. Number one, if you have something like this from 0 up to 19, call yourself an investor. Don't call yourself parent. I'm begging you. You are what? An investor. So 0 to 19. This is a mere investment. So this is investment, mere investment. Kindly use IFRS 9. Okay? Use IFRS 9. So if you have 19% interest, you can command 19%. Please don't tell yourself that you are the parent. So they should allow you to prepare consolidation. No, please. I'm not a parent. You are what? A mere investor. That's all. But if you have 20%, 49, we call it significant influence, and that is associate. We call it what? Significant influence or associate. Significant what? Influence or associate. If you have 50, exactly 50, joint venture or joint arrangement. Joint venture or joint arrangement. If you have exactly 50% joint venture or joint arrangement, and kindly use IFRS 11, this IFRS IAS 28. But if you have 51 up to 100, in fact, that one you have what? Control, full control. You have control. So take note of this accounting boundary. So control, simple. In simple case, presume to exist if you do have more than what? 50% equity shares. That is it. Good. So that's control. Now, significant influence, simple means yes. Significant influence, meaning that you can influence the decision, but you cannot make impact. There's a difference between the one who has the power to make policy and the one who can influence the policy. Influence, like you, someone consulting, when you're giving advice to the person can take the advice or move on. That is influence. But power, if you say the person cannot change to be 3, that is power. So take note, if you have control, when you say 2, you cannot change it. That's the control. Okay. So basically, that is it. So now let me go to associate. I was about to define associate. So associate is an entity which the investor have a significant influence. And that is not a subsidiary or a joint venture. So when we mention associate, is an entity which the investor have significant what? Influence. Significant influence. That is not what? Subsidiary nor the joint venture. That's also meaning that associate is not a subsidiary, and other word, a joint venture. So take note of the definition for associate. So, and to know whether this is an associate, check the percentage holding. If you have from 20 up to what? 49%, then qualify to be an associate. You only have what they call significant influence. The influence is what? Significant. But if you have 0 to 19, don't come close. You are a mere investor. Good. Now, when you talk about significant influence, it is the power to partake or participate in the financial and operating decisions of the investee, but not the control. So let's take the significant influence. What is a significant influence? That examiner. Significant influence is nothing by. So significant influence is nothing by it's a power to partake or participate. Participate in the financial and what? Operating policy decisions. Operating decisions or policy decisions. Again, of the investee, you can say parent to of the investee or the investor. So you can't say subsidiary. You have to say investee. And you should know the term. I write you. Where does control? The one that have control is called parent, right? Good. So under control, you have what you call parent versus what? A subsidiary. Take note. Under significant influence, we have what we call investor and investee. Investor and what? Investee. So take notes of these terms so that when you're using them in exams, you are fine. So where there's control, feel free and be mentioning parent and subsidiary. Where there's no control, where there's significant influence, don't be mentioning parent there. But the moment you mention parent, everybody's mind comes on what? Control. You are an investor. Okay. So that's all.
I have a question here. So when there is an investor,
in this statement, then we don't want to specify by one company. It's a subsidiary to many parents. No. So if that company is a subsidiary to this parent, only this parent. So that is that. Now look at for situation whereby, in fact, you don't have up to the 50. I will still control. You will still have control. Good. So I'll give you some situation where you don't have 50%, but you still have what? Control. It means that control is not necessarily about what? The 50% threshold. Now we get it. Good. Okay, so situations where the parent does not have control or does not have the 50% threshold, but there's what? A control. It's also the same as situation where, in fact, let me explain this. The one that has the control is the one that's allowed to consolidate. So if you have control, parent is the one that's allowed to what? Consolidate what? The subsidiary. So parent results, maybe sales revenue. Here's 300, here's 200. So group sales revenue, you add a 2, that was 500. Good. So take note of that. So parent is the one that will be allowed to do what? To consolidate. But sometimes we have a situation whereby parent does not have control. Or you don't have the 50% threshold, but there's control. Let me start with that one first. Where you don't have 50%, where the 50% threshold, is absent, but still there's control. Wow. In fact, you can even have 0%, you can still control the financial statement. And once you control, you can prepare financial statement. You can consolidate. What are the circumstances where you don't have cut the 50% by full control. Good. Now, situations where you have number one is situation where power over the investee has been established. Now, IFRS can give us three conditions. So, the first one, let's examine the situation where the investor have what? Have power over the investee. That is all. Where the investor have what? Power over the investee. That is all. Where the investor have power over the investee.
This kind of power.
Good. Now, here we are saying that where the investor has a current ability to direct the activity, that significantly affects the investee's return. So that is the first point. So where the investor have the power to, in fact, have the power over the investee. So, and the power, we are talking about power to direct the activity of the entity. That is all, power over the investee. So where you have power, in fact, you even have 5%. And if you give command, then it moves. If you give commands, they take it. Good.
Before we continue, I don't want to say that I have 2 quick questions. So with the consolidation.
Okay. So basically, that is that. Then I'll also look at this. Now, for instance, let me give you a critical example. Let's assume that I have to just 20% control, but 20% percentage holding in a company called Papa Limited. This 20%, the other people who have the 80%, none of them, the other percentage is being held by over millions of shareholders, and none of them even have up to what? 1%. None of them even have up to 1%. Then indirectly, I can count myself the head of board, the family, because I have 20%, and the rest of you have what? Not even up to 1% individually. So if I can team up and organize few of you, come and join me, so we can change things. How we get it? So this is when the investor have what? Power. Investor have what? Power over what? The entity, basically. Okay. Now, the second section, where you don't have control, but you will be allowed to consolidate. So this particular question, it has done before in UPSC final exams. Yes. Okay, so let's see. The next point is exposure or right to variable returns from involvement in the investee. So B, situations exposure. So let's examine now. if you are exposed, or you have the right, or you have the right to a variable returns. So variable returns from involvement in the investing. So like you're going to involve yourself, though you don't have 50% threshold, you've not met the 50% threshold, but you have what? Variable return. Good. Variable return. That is all you're allowed to prepare consolidation. Now, the last section, then we move on. The last section, then we move on. Is the ability to use the power over the investee to affect the amount of the investors' power. Sometimes investors have what? Power. So ability to use the power. So the last point will be the ability to use the power, over the investee to affect what? The amount of the investors' return. The amount of what? Investors' return. That is all. Amount of investors' return. Now, let me give you a critical example. Now, assuming that we are a company and we secure finance from a bank. Imagine this bank will come and then appoint a member onto our board free of charge because we have their facility and they want to protect their facility. They are protecting their return. Now, this bank will not tell us what to do, have power on us. Yes, employ this staff, don't employ this staff, pay this amount, don't pay this amount. Yes, they are giving or they have power of our financial activity because we have their facility. And that's the typical. This bank does not even have 50% control. That's not control. But if you are allowed to consolidate, that's all. This bank does not even have, they have in fact 0%. There's no control. No control. But the mere fact that they can direct or they have power over financial activity, but because they're giving their facility to you, now they can prepare consolidation. That is all. We are done. Now let's move on to the next topic. Very important. It's still under control. Control have three things that I need to know. Now look at one. I'll go to the second one, and then we move on. The next section of control talks about exclusion of parents from presenting consolidation. Now, let's assume this one. I have to explain it. Where to get it for me? I'm a parent. I'm here. I control this subsidiary. At what circumstances would the law or the IFRS will not probably permit me to consolidate my subsidiary? How we get it? So circumstances where parents will not be allowed to prepare what? Consolidation, or parents will be excluded from presenting consolidated financial statement. Even though I control this, I have, let's say, 60%, which is more than control. In fact, let me even wait the case. I have 100% stake in this company, but they will never allow me to build consolidation. This is a direct opposite of what we just looked at. That situation where I have 0%, I can still prepare consolidation. Situation where I have 100%, I cannot prepare what? Consolidation. How do you get it? Good. So this one can look at the topic well because it contradicts or it's slightly confused with the next one I want to do. The topic is exclusion of parent from presenting consolidation or consolidated financial statement. So let's write it full. Exclusion of what? Parent from presenting consolidated financial statement. Like this example, I owe 100%, but they say no way. You'll not allow me to prepare consolidation. We have four of the conditions. So conditions where parents will not be allowed to prepare a consolidation or not be allowed to present a consolidated financial statement. So don't consolidate anybody. Rule number one, if the parent itself is wholly owned or partly owned, that's all. If the parent is what? Wholly or partly owned subsidiary, that's all.
The parent itself is also a subsidiary.
The parent itself is also a subsidiary. So meaning that there's an ultimate parent here. There's an ultimate parent here. He owes this maybe 70%. So long as you are a parent to someone, if this parent is going to prepare consolidation, you will not allow it to prepare because your overall cost is preparing. You can also prepare. However, situation where these parents are not preparing, they will allow you to prepare. Good. So take note of that. So when the parent itself is what? A wholly or partly owned subsidiary of another entity, and all 8 other owners, including those not have been informed, and then that is all. So just the examiner. If you yourself, someone controls you, and that person is going to prepare financial statements or consolidation, please don't consolidate your members. Can you give your members the email to consolidate? That's all for consolidation to take place. Then the next point talks about number 2. If your debt and equity instruments are not traded publicly, if what? If it's debt and what? Equity instruments. So debt or equity instruments are not traded publicly. Meaning that if you are not on the stock market, that's all. Whether domestic or foreign, any stock market at all. It doesn't matter. It includes local, regional, domestic, yes. So if you are not on any stock market, do not prepare consolidation. But listen, as you come to complete. Let's go to point number 3. Point number 3 says that if it did not file, so this, let me write the point 3 here. If it did not file, so point number 3, if it did not file or it is It is not in the process of filing. That is all. So if you are not listed, you have not filed for listing, maybe you filed for listing, but now it's not ready, but I can still allow you. If I'm not done that, or you are not in the process of filing, please don't consolidate. So if this parent did not file to be listed, or it's not in the process to be listed, you will not be allowed to prepare consolidation. That's all. It all works on the second point. The second point, if I'm not listed, this one, if I'm not in the process, good. And then we look at the very last point given to us. If it's ultimate, or any intermediate parent produces consolidated financial statement and that are publicly available, and you comply with the IFRS, which will not allow you. Let me take my time break that point for you. The very topical issue. What is issue of control? Three questions can appear. The first one, we look at it. Second one is here. There's a third one. Then issue of control. Say bye bye. Point number 4. We are saying that if it's ultimate parent, ultimate what? Parent, or any of the intermediate parent. What's the difference between intermediate parent and ultimate parent? Basically, intermediate parent produces consolidated financial statement. So consolidated financial statement, and it is publicly available and comply with what? IFRS. Let's see. Let's assume that this is the parent we're talking about. There's another Jane here. There's Q here. So all these people, this one owes this, this one also owes, this one also owes this. You will not be allowed to prepare consolidation. This one becomes what? Ultimate parent. And this one becomes what? The intermediate parent. So the intermediate parent within a particular group, if any of this, they produce consolidated financial statement and publicly available and comply with IFRS, you know, they're allowed to prepare consolidation. Because there was a situation whereby somebody will claim ownership over you and you don't claim ownership over someone. So take note of this. I am done with this particular point, only 4. Good. Only 4. Only 4. Then we are done. Then we have a situation where a subsidiary will not be allowed. A subsidiary will not be consolidated. So we have exclusion of what? Subsidiary from consolidation. Exclusion of what? Subsidiary from consolidation. Good. Basically. So what we've done so far is exclusion of what? Parents. So what I'm going to look for is exclusion of who? Subsidiary from consolidation. Or amount to what? This consolidation. So exclusion of what? Sub from consolidation. So at what point that you be allowed not to consolidate the subsidiary? Can we parent OB at the same time OA at the same time O, let's say Q? You will not be allowed to consolidate this. This is a subsidiary. You are allowed to consolidate the remaining subsidiary, but this one they don't consolidate. At what point? How do you get it? Yeah, we are not saying if he himself is a subsidiary of someone. No, no, no. We are not saying at what point this guy cannot consolidate this. Good. So that is it. So point number one. Here the IFRS 10 consolidation provide only two circumstances or only two factors that can lead to this. So number one, where the subsidiary is held for sale. So held for sale subsidiary. So if you are selling this subsidiary, please don't consolidate the subsidiary. It is held for sale. Can you use what you call IFRS what? 5. Available for sale financial asset or non-current asset and discontinued operations. Point number 2, where there's no control. Where there's no control, that is all. Where control does not exist or lost. If recently if lost control, please don't consolidate. Normally you have 70%, and then the company floats a new shares in the market. Instead of you going to buy additional amount to maintain your position, we are relaxed, and plenty people acquired more than, and now in fact it has moved you to a mere investor. Good. Now, when the examiner asks you, tell the examiner that Mr. Examiner, honestly speaking, there are only two factors permitted by what? The IFRS. These are the factors permitted by the IFRS. Then we have other factors that one they are not permitted by the standard, but the directors may depend on that factor and they will not consolidate that subsidiary. What are they? So other factors. These ones are not permitted by what the IFRS is. Number one, when the subsidiary is making consistent losses. But directors don't want their good reputation, their good name destroyed by who? This particular subsidiary. They don't know consolidate this subsidiary. No. So when the subsidiary is making what? Consistent losses, the directors cannot be happy to consolidate. One, different business activity. Different business activity, such as the parent company is into mining, subsidiary is into audit. Parent company is just a manufacturing company, but the subsidiary is just a transport company. These activities are what? Different. And number 3, struggling years, reporting years. Parent reporting date is 31st March. Subsidiary is 1st January. So due to this difficulty, reporting difficulty, the directors may decide that, okay, we're not going to consolidate this. All these 3 points are not permitted. They are not the one permitted by what? The IFRS. It's people's like best practice, what they have established. So that is it. Now I'm done with the 3 sections of what? Control. 3 sections of control. Now I'll back this a few illustrations. So you can look at just last sentence for now, just read it out and then you take it from there and go work on it. Yes, I'll just read it and then project it for you to see. Okay, so look at the D part. IFRS 10 consolidation. IFRS 10 consolidated. IFRS consolidated financial statements outline the requirement for the preparation and presentation of consolidated financial statements. Require entity to consolidate other entities into what? Controls. Define control. So control is just the power to govern financial and operational operating activities. That's all. For the return. 2. Indicate 4 circumstances that an entity may not have gained control, don't have the 50% threshold, must not even have 1%, but may be allowed to prepare consolidated financial statements. If you have power over that, if the investor has one power, even if the figure is not even up to 50%, don't worry, consolidate. In that order. Basically, now let's continue with the game. Okay. Now our next section. Okay, so in regards to that particular one, I write some 4 points, extra point for you. Where the 50% threshold does not exist, but you will still prepare consolidation. We talk about when you have what? Power over the entity. For instance, that power. 2, where you can remove member from the board. Where you can remove member from the board. I'm just extending that 3 points I gave out. Just adding more to it for you. Power to what? But power to appoint or remove. You have power to appoint or remove members of the board. Power to move members to the board. Majority. That is why a bank. If a bank have given you a financial statement that gives them power to appoint more members onto the board, they can be allowed to pay for this, even though they don't even have up to 50% threshold. And then power to cast majority votes at meeting. If anybody has the power to cast majority votes, power to cast what? Majority votes. Cast the majority votes. The example is the one that you owe 20%, and then the rest, the over million shareholders, none of them have up to 1%. So if all of us are casting, I will cast what? Majority. I will cast 20. None of them can cast 1. Unless they come together before they can cast 1. But I can cast 20 at a time, unless they get together. How do you get it? Good. And then power over more than half of the voting right. By the virtue of what? Agreement. Power over more than half. Power over more than half. By the virtue of what? Agreement with the other investors. If you agree that, oh, let this guy control, because even though it does not have 50%, let's all agree. Let's all agree. That is all. Okay. Let's take point 4 again. Point 4 says that power over more than half of the voting right
Okay,
by virtue of what? An agreement.
okay.
That one, all the other people, let's say there are 10 people, and then I owe, let's say, in fact, they owe 5. Let's say there are 11 people here. Everybody owe 5. So together they have 55%.
Sure.
Me alone, I have 45%. And then I'll say to them, and then please, bosses, individually, I have more than all of you because you alone, you have 5%. So I'm begging you, not telling me I'm begging, let's agree so that I will prepare consolidation, okay? Because if any of you prepare consolidation, means I can't prepare consolidation. Good. So let's agree, okay, for the first 5 years, don't worry, prepare the consolidation. That is the point. So power over more than half of the voting right by virtue of what? An agreement with the other investors. It can even happen that the shareholders are like individual members, like persons. Good. And then the only investor is the bank who have loaned them about high amount of what? Debt. So therefore the bank go ahead and then prepare consolidated financial statement. Sit with the investor that please, you are individual, you don't have financial statement, your stocks are not doing on stock market, you are in the single individual. We are a bank, corporate bank. So can we consolidate? If they agree, go ahead and do the consolidation. Okay, so we are done with a little issues. We are now going to start with the actual consolidation. So in consolidation, there are 3 of them. So let me list all the consolidation, and we start with the principles. Okay. Now, what happened is this. In consolidation, the financial statements are the financial statement that we are going to consolidate. We are going to consolidate the comprehensive income. We are going to consolidate changes in equity. Any financial statement at all. We are going to consolidate financial position. We are going to consolidate the cash flow. That's all. And other issues. Other complex issues. That one, we are not going to do it here. Complex issues. So that's all about consolidation. Now, we are going to consolidate the comprehensive income, change in equity, but for financial reporting exams, we are going to look at for only the first 3. Just the first 3, no cash flow. Cash flow is for the final level or corporate reporting or strategic business reporting. That's why we require to prepare consolidated with cash flow and other complex issues in consolidation. Good. So let's see. Unfortunately, I'll start from financial position. And then if I land myself on what comprehensive income and pick a question and look at things negative. In all, there will be 1 subsidiary. We look at associate. That's number 1. Number 2, we look at a foreign subsidiary. But a foreign subsidiary is not part of financial reporting. So I will not touch it at all. It's in corporate reporting. Foreign subsidiary, where some of the subsidiaries are overseen. How do you translate their financial statement into the reporting currency of the parent and now consolidate it. So that one, there's an issue of what translation and finally issue of what reporting and then consolidate them. So let's start with consolidated financial position as a balance sheet. How to consolidate balance sheet. Now, consolidated balance sheet becomes so easy. So easy. So you need 6 to 7 standard workings. The consolidated statement of financial position. Good. So consolidated statement of financial position. Please don't forget. Consolidated statement of financial position. What are the basic principles that we have to look out for? So let's assume, I'm just assuming this parent did the subsidiary. I'll start with wholly owned subsidiary. Wholly owned means if applied what 100%. No NCI matter. You don't share that subsidiary with anybody. Wholly owned subsidiary. So financial position. Okay. Let's assume that this is their non-current assets. Let's say total assets. I'm adding everything together. But let me do this one for you. Non-current assets. What the PPs? Here will be what? 300 and 200. Current assets. This is 50 and this is 25. But 20. Total asset is what? 350. And here is 220. I'm starting from a very basic ground for you to understand consolidation. This is the total asset. Go to equity, stated capital. So stated capital are reported in dollars. Just 200. This guy, the stated capital is nothing by 150. Let's assume that the retained earnings, retained earnings this guy's own happen to be 50. But this guy's retained earnings is just 20. Let me be where's the case. It's just 30. Okay, so non-current liability or total liability. Total liability. This one to happen to be 100. And then this one to happen to be 40. Now it has balanced nicely. Let's prepare consolidation. So I'll give you a very simple picture about consolidation before we come and add the complex issues in. So this is 350. This is what? 220. So this is where they've not seen each other. This is where these two people they've not seen each other. This is where they are just reporting, normal trading. They are just reporting. So let's assume that right after this balance sheet, this parent saw this subsidiary and acquired everything and started with wholly owned subsidiary. Wholly owned subsidiary means the parent have what 100% interest. He bought all the equity shares. How we get that is wholly owned subsidiary. So how are you going to prepare the consolidation? Now, you must pay something, right? He paid something. He paid for this amount. Let's assume that the parent paid for, let's say, the parent paid for 200 cedis. The parent paid for 200 Ghana cedis. Good, 200 cedis. I'll swap something in here. 200 cedis. Let's assume that this is 250. Yes, and let's assume that this one is 100. Okay, so make the changes for me. Other than that, the parent not get money to pay. Yes, if I don't make it like that, the parent not get money to pay. I don't want that to look complicated. And then you drop it down to the liabilities because you're owing. And once you're buying company, please don't owe. Pay the money outright. Okay, so kindly make the changes for me. Let's make it 100 here, 250. Good. Okay. So third examiner, this balance sheet is asset. This financial position, let's put it in there. The financial statement of financial position as at 31st December 2019. So the next day, the parents saw the subsidiary and make an interest and propose to acquire everything. In fact, they acquired everything. 1st January. So how would the consolidation be like? Let's pay the consolidation. First of all, parents acquired everything. Tell me the net asset. Now the net asset simple means we measure net asset in terms of your stated capital plus the reserves. That is your net asset acquired. So that is our net worth asset. I will explain this net asset further when we start with the actual principle. This one is just guidance. So this parent acquired everything. So tell me the total amount acquired. The net asset of the subsidiary is what? These two coming together, which is what? 180. Parent have acquired everything here, and he paid what? 200 Ghana cedis for it. Good. So tell me the accounting entry in parent financial statement. So let's prepare a new balance sheet for the parent right after the payment. So after the payment, the parent balance sheet will be like this. So parent balance sheet right after paying that 200 Ghana cedis to acquire. So meaning two things will happen. It will increase the parent's non-current assets, right? Because it's an investment. In parent balance sheet is an investment. We call it equity investment. So parent will have, let's say, non-current assets of, let's say, so 100, and then equity investment. Or in short, let me just follow this approach. So the parent's non-current asset becomes what? 300, agreed. Because to me, the 200 that he paid plus what? The 100 that has already here already. How we get it? So current asset for the parent becomes 300. Good. So parent paid for, that is the cost of consideration. So cost of consideration is equal to $200. Now, what happened to the current asset? Well, the parent will have to draw cash or check from the current assets, right? The current asset will be by how much? 200 Ghana. Good. So here, let me do what? 15. So consolidation does not pay the balance sheet then. I like that. So therefore, total asset becomes still what? 350. Total asset is still what? 350. And nothing affects the balance sheet because two entry, nothing affects the equity and liability side because nothing affected. So copy everything. Equity is still 200, retained earnings is still 50, and then this will still be what? This will still be that of 100, it is still 350. How we get it? Good. So this will be the parent's new balance sheet right after the acquisition. Subsidiaries financial position will not be, it will not change. Subsidiaries or financial position will not change, to be intact. So now prepare the consolidation for me. So that means I now need to consolidate these figures. So let's prepare the consolidation. So we have to put these two figures together, because right after payment, we'll take records of the amount you paid, and then we get our new balance sheet, then we consolidate the two together. So let's prepare consolidation. So now consolidation, small consolidation here. So consolidation, group. Now consolidation means we should add the results together. Now the 200 for the subsidiary and 300 for home parent. But this 300, it includes the 200 paid as what? As a cost of control. So this needs to be what? Eliminated. How we get it? This 300 here is made up of two. The normal non-current asset of 100 plus the equity investment of what? 200. How we get it? That makes the 300 over here. No, I think it's 100. Okay. We don't consolidate any amount paid to what? To acquire the subsidiary. Yes. Consolidation simple means we should add them line by line. Every line item need to be what? Added together. Pick the parent and pick the subsidiary. Put them together, and that is all. How we get it? So if I start with non-current asset, parent 100, subsidiary 200. So total non-current asset becomes what? 300. Parent owned plus subsidiary. This 200 is an amount paid by who? The parent to acquire the subsidiaries, and it must not be consolidated. Only own, just consolidate line by line and move on. Now, the net asset of the subsidiary happened to be 180, but the parent paid how much? He paid 200. That means the parent have paid more than the value. So there's something called goodwill. Fine. So the parent have paid a goodwill. So tell the examiner a goodwill of what? 20. How do you get the goodwill? Parent paid 200, but the net asset is what? 180. So therefore, parents have paid what? More in excess by what? 20. And that becomes the goodwill. Goodwill is a non-current asset, intangible asset. Fine. Let's consolidate the current asset. Let's go to the current asset. Current asset to parent own is 50, subsidiary own is what? 20. So now we get what? 70. So parent own 50, subsidiary own 20. Now we put this together. We now have what you call 390. That's the total asset. Let's go to equity. We don't consolidate the equity section of what? A subsidiary because of the goodwill calculation. We don't consolidate all the equity section of the subsidiary 180. That is what we use to calculate what? The goodwill. So we're not going to consolidate it. Fine. So when you go to equity, only parent. So parent to the capital is still 200. So we will do what? 200. Then parent return is still 50, right? Then you go to the liability. The total liability subsidiary is what? 40, right? I write it to 40. And then parent is what? 100. So putting the two together, you get what? 140. Let's add all and let's see. So putting all this together, we should be able to get what? 390, the new balance sheet. That's all about consolidation. That is all about consolidation. So simple consolidation. But here we are going to affect with a lot of what? Principles. A lot of principles. Good. So that is how consolidation will be. So let's just. So I'll now take my time and go through all the principles one after the other. What we've done is just a pre-sync. of the actual gain. Good. So that is it. Now I'm going to make some few changes here and see how it will affect consolidation. So kindly let's see something. What if the parent paid exactly 180? The parent paid exactly 180, no goodwill. He paid, this is a balance sheet before. He paid exactly 180. What's the accounting treatment? Take 180 from the current asset, from cash, add it to non-current asset. So the parent pay 180. So the equity investment now becomes 180. I'll take the 250, 180 from 250. You give me 70, right? So in consolidation, let's see how the consolidation will look like. I will do 3 of this for you to get a clear picture. Parent pay 180. Meaning that in consolidation, there will not be any goodwill. No goodwill will exist. Good. No goodwill will do what? Will exist. So let's see what will happen here. If there's no goodwill, let's compare the consolidation. This section, and then non-current asset. Subsidy 200, parent 100, stored 300. Don't consolidate the amount paid. Then again, the current asset becomes what? 90. 20 plus what? 70. So that gives us the same 390. That's what? Balance nicely again. Friends online, are we saying that is one? It is the principle that we are applying here. Now let me go to the last one. We call it partly owned. Where parents acquire, let's say, 60% or 80%. Good. So let's assume that the parents acquire 90%. 90%. How the financial statement look like? That one is a bit complicated because there will be 2 streams of what? Interest. The one coming from the parent and the one coming from the other people. So let's see. Still, let's maintain this. Let's assume that the parents acquired 60% control by paying 180. Now the parent acquired what? 60% by paying 180. Nothing will change in the parent financial statement. How we get it? It will not affect the parent financial statement. However, the parent, the consolidation or the group account will be affected. That is all. So I'll do that section somewhere here. It's a bit complicated, so kindly follow little by little. If parent acquires 60%, we are saying that the parent financial statement will not change. But let's see how it will affect the group. Because you still pay 180, so still 180 will be recorded. What happened is it? Now, because parent does not wholly or fully control the subsidiary, there must be a portion on the balance sheet that is for the other people. Those people that owe 40, what name should we call them? The NCI. So those people that owe the other 40, I said, let's call them what? NCI, non-controlling what? Interest. Formerly known as minority holders. And they were annoyed that we are insulting them, that they are minors. It's okay, don't worry. We'll call you non-controlling interest. Not knowing if we insult them again. Non-controlling interest. You have interest, but the amount was controlled. How? So that means there must be a portion on the group account which must be belongs to them. That is all. Which should be their portion. So part of the equity. So we have to find a way. It must be part of the net assets. Some part must also belong to us. That is all. So and see. So I'll perform some small calculation here, but on the top for you to get it clear for me. Let me do it here. I need a full space. Let's see if there will be goodwill. Let's see if there will be goodwill. Goodwill, I'll come to it, but it simple means whatever you pay, if it is more than whatever you've acquired, the difference is what? Goodwill. So purchase consideration. So consideration paid. Consideration is 180. Then let the net asset acquired. So tell the examiner, net asset what? Acquired. So net assets acquired. Parent share. The total net asset is what? 180. Parent acquired 60% of this, so times 180. Average. Parent have acquired only 60. So the 60% will give us
10.
So 108. So therefore, parents are paid more by what? 72. So it's a goodwill of what? 72. Parents are paid more by 72. So therefore, let's write goodwill 72 on the balance sheet from the consolidation. Okay. Now if I put 72 here, as goodwill, let's see something. When I go to the equity section, I must put a section, or I must demarcate part that I do not control. The entire net asset is 180. I control 60%. Now let's go 40%. So can you find 40% of 180? You still get what? 72. Find somewhere right up after the equity section. So in between your equity and liability, create a line and call it what? NCI. That's their position. So in between the equity and the consolidated financial statement, tell the examiner NCI. Those people that they do have control. They have interest, but they don't have control. So you find 40% of the total net asset. You get what?
43.
Now 40% of 180 should give us 72. So that will give us 72. So now let's look for the new balancing figure and see whether if it will balance. So now it will be 300 plus 72 plus 90. And that's to give us something like 462. And here to be what? 462. Are we saying this is basic consolidation? So actually, when I start with the principle, you are fine. This is consolidation of what? Financial position. Basic one. If not, in fact, treated anything to just set the main reason or the main concept behind the consolidation. So that is all. Okay. Now, unfortunately for us, this is not what the good Lord will bring us. But we are not going to end here. To continue, I have all the principle or step-by-step approach, which has been explained. So can you use that one? So probably I'll make it available to you. Or can you check the description section and then use the principle? Good. Great. So all your lecture videos on consolidation for you to get the full aspect of it. So first, kindly go through the consolidated financial statement, and then part 2, the financial statement itself, financial position, intra-group adjustment, and fully solved consolidation for our next meeting. Our next meeting, I'll pick up 4 questions. If you're able to go through all this, you should be fine with the principles. All these explain the principles. This one explain all the steps involved. First one, sorry, the third one explain all the steps. What we've done today cover the first 2. The third one explain all the steps involved. Then the 4th one start with the financial position part 2. And then it continues like that. Great.
I have a small question here.
Great. Kindly subscribe if you have not done that and share the video with your friends. Goodbye. Have a nice day. See you the next one.